Thank you for joining me. So, is the stock market is the stock market up too much, too fast, or should you jump out now? Should you take your profits and run before the other shoe drops? Is it time to maybe rebalance your account? That's what we're going to talk about today. Is the stock market up too much, too fast? It's time for a stock market reality check. So let's get into it. We're going to do the quick intro, as we always do here. And then we've got some really interesting things to talk about. Here goes. Hey there, everyone. My name, if we haven't met yet, is Mitch Goldberg. I'm a financial advisor with decades of experience, and I am with a wealth management firm called Client First Strategy. You can see by the artwork up top. So I appreciate you joining me. We're going to talk about the stock market because it has been the quickest rally we've ever seen in this short amount of time, going from the recent March 23rd low. So we've got a couple of things to talk about, but I call this episode Reality Check. The stock market, has it gone up too much, too fast? Are investors expecting a little too much? Maybe investors are completely wrong and this market should not be up at all. A lot of people think that, so we need to get into this. So if you have any questions during the live stream or the replay, welcome. I'd love to answer your questions in the comments below. Your words of encouragement are always appreciated as well. Don't be shy. Introduce yourself. Hey, I'm a nice guy. I won't bite. I love the interaction, the back and forth. This is like, I love this stuff. It's the best part. So I hope you're going to get well, you know what? You're going to get a massive amount of value out of this. So I'm going to kind of freestyle here, okay? We're going to freestyle about the market, about what's going on. The first thing I like to do is I start every episode with a quick review of the day's action with a screen share, and just to get us in the groove of what we're going to talk about. So first thing I'm going to do is I'm going to share screen. I'm working controls here. I'm going to pick the screen to share. I've got a couple of screens and monitors in front of me, so just want to make sure I share the right one. Bam. You should have it right there, and you do. So you see the Dow up almost 600 points. I mean, today's Wednesday, so yesterday, the day before, we saw some pretty decent up days. We saw a decent up week last week and the week before. The S&P up a whopping 42 points, not as quite as good percentage-wise as the Dow, but I'll tell you why the Dow was up a good deal percentage-wise more than the S&P 500 in a moment, because we're going to take a look at the stocks that contributed the most to today's move. And you see the NASDAQ is up 0.78%. Good, okay day. Hey, listen, an up day is an up day. Okay, we'll take it. The NASDAQ's been leading the way for the last 70 days, 75 days, that's about 80 days since the stock market bottom of this recession, of this bear market. So that's okay if another major average takes the helm, takes the mantle for a little bit. And of course, the small caps had the best performance of the day. And they've been really in rally mode also, still behind the major average, the other, behind their larger brethren. And the VIX, I point this out every day. The VIX is down 4.4% today. That's the red. That's a good red. You want that to be down. That is a good red. It's called the fear gauge. You see, when basically large professional investors are invested, and when they're worried about the stock market, they use derivatives to express their thoughts, their fears, or their greed. And what this tells you is that it was down when the market was up. And sometimes it goes up when the market's up, but when it goes down, it tells you that professional traders are feeling a lot more comfortable with this rally that we're in. So it's a good thing. It's the lowest it's been since the March 23rd stock market low thus far. I say thus far because you never know if the market's going to make another dip. I don't think it does. Well, I mean, not to that extent. But we take a look at the VIX down to 25. It was in the mid 80s at one point. So that's a pretty substantial drop. Before this whole shebang happened and the COVID and the shutdowns, the quarantines, etc., the VIX was below 20 and as low as 12 for, in the 12 range for, let's say 10 to 14 range for a while. Okay, let's go on. The stock market, you see that orange line? That's the 200 moving day average. And I've been talking about this 200 moving day average for like the last 2 months. And what I've been saying is if the market can, if the S&P 500, that's the blue, can cross above the 200 moving day average, that means this rally is for real. And it means that there's a lot more comfort with stocks. And something I pointed out also, and it bears repeating, that investors go into performance chasing mode, where now they're overly cash heavy. They have too much in cash. They sold off too many stocks, down here when things, you see my cursor there, down here when things were lower. And now that we're over the 200 moving day average, these fund managers and hedge fund managers, they're thinking, holy smokes, my performance is so much worse than the S&P. I am so far behind that I have to jump back in and start committing or recommitting my cash back into stocks. And what are they doing? They're buying everything. They're buying stocks that are up a lot, and they're buying the stocks that have, high beta. That means stocks that can go up a lot when you think that the economy could improve a little bit. So they're jumping into cyclicals, airlines, consumer discretionary stocks, cruise lines, that sort of thing. So we are solidly above the 200 moving day average, and that's just a bullish sign. And the higher above that we go, the more money managers I think are going to be feel pressured into investing their cash. They just have to say, you know what, we got to get back in. More fuel for the fire. Let's take a look. You remember I said, I was going to explain to you why the Dow percentage-wise today was up so much more percentage-wise than the S&P 500. It's because this one guy over here, Boeing. Boeing is up 13% today. That, for a company the size of Boeing, that is a massive move. I mean, Boeing at 173. This stock was 100 recently. It was down to 89 at its year low at the bottom of this, bear market that we just had. It's past tense already, and it's really remarkable to see a stock like that go back up. But they're committed to the max lineup of aircraft and getting that going again, and airlines are starting to fly, and maybe orders will start coming in. And long term, Boeing, if you look at over the next 15, 20 years, 5 years, okay, we don't have to go 20 years out, 5 years, they do have a very bright, a very high, if you get to the very high future, see that kind of play on words, you see, whatever. Okay. Raytheon up over 6%, Amex up, JP Morgan, Exxon Mobil, nice little performance from Nike, but Goldman Sachs, Travelers, Caterpillar, Disney continues to climb higher, Chevron. Let's see some of the bottom performers. Look at Walmart, worst performer in the Dow. Not terrible, down less than 0.4%, but that's one of the FANG stocks. So it's interesting to see that FANG stocks are starting to come in a little bit because people feel that they've maybe have gone up enough, and it's time to bet on a new horse. We'll go a little bit more. I look at this every day. These are the exchange traded funds, ETFs, for each of the major indices of the economy. There are 11 major classifications or industries in the economy. And I always say the ones that you want to see lead are industrials, energy, financials, I'll take materials as well because they're very cyclical. So it's cyclical means they're very sensitive to the economy. So if investors feel bulled up in the economy, these stocks should do better than stocks, let's say like healthcare, which makes drugs, for example, and consumer staples, companies that make things you need like toilet paper, toothpaste. Those might not do as well when people think the economy is going to improve because those companies, their earnings won't grow that much, the consumer staples and healthcare, but they won't go down as much as cyclical stocks in a recession either. So healthcare and consumer staples have held up a lot better. But now the mantle, the baton, I should say, the baton is being passed, and it's going to the cyclical sector. So this is what you want to see: industrials, financials, and energy. You want to see those climb up. And just if you want to know where there could be value, okay. Let's see if the screen comes up. Okay. Well, I was going to show you the XLF performance. Here it is, the year to date. This is the XLF, okay, for the financials, the ETF that follows the financial sector. Where'd you go? But the point is, it's down about 19% year to date. That's really what I wanted you to see. So there is definitely a catch-up trade that is taking place, and people are investors, I should say, are running into the stocks that should do well when the economy improves. Okay, so let me just move my book over here. So that's what's going on with that. And if we want to find another pocket of strength, let's see if this one comes up better. Okay, so the XLE, the energy. I'm going to stop sharing the screen here, but the XLE that represents. Oh, now it comes up. So maybe I will do the share screen again with you. Okay, so we'll put that back real quick. It's worth taking a look when you see this, that it's down still 30%. You see that? 30% year to date. All right, so I just wanted to show you that. So there are still pockets of value. There are some energy stocks that I happen to like, and I don't know if I really want to name them on the live stream, but I will definitely let you know if you want to give me a shout, okay? But just keep in mind, I stick to the biggest investment when it comes to energy, the ones that I expect will survive, okay? So now we're going to get into, is the economy up too much, too soon, and what do we need to dissect? So the economy is still in tatters. We still have the unemployment rate sky high. The May figures are coming out on Friday, June 5th, 8:30 a.m. We get the non-farm payroll report, and it's expected to be, continue to be pretty horrendous. Tomorrow morning, we get the first-time unemployment claims, and last week, we got another 2 million plus people filing for unemployment claims, and we will see if that reverses tomorrow. But we need to watch these figures very closely, and these will be the telltale sign that the recovery with the reopening of the different states is starting to work. So we've got a pretty crummy economy, but stocks have crossed over their 200 moving day average. Mortgage applications are flying. Those are really good numbers because of first-time home buyers. So millennials are buying houses in force. That's a very good sign because it's one thing to refinance a house, but it's another thing when somebody buys a house and moves in for the first time, because there's a lot of money that goes into that house. There's carpet, appliances, redecorating, construction, all that. So these are some very good things for the economy. Interest rates are still very low. Corporate borrowing has been pretty easy. So companies that, big companies are still able to borrow money. Even Macy's was able to borrow a couple of $1 billion in a money raise in a corporate bond fund. So is the market too high? Look, too high is an opinion. Does something cost too much or does something cost too little? Do I think the stock market over the very near term could keep going higher? I do. It's pretty gutsy to say, but I've made gutsy calls before, and I know that long term, I'm going to tell you the same thing. Long term, stock market will be up. That's how I feel. Long term, it'll be up. We don't really have to worry about that. But between now and the near term, between now and the intermediate term, that's kind of what you are probably the answer you're looking for. And I know that's what you want. And because I'm such a nice guy, and I'm going to give it to you. I think near term, the stock market still has some kick to it, some steam, because we're over that 200 moving day average, which we just talked about. A lot of money managers are still too far behind their benchmarks. They've played it a little too safe, and they've got to play catch up. For my clients, if I'm wrong, I'm wrong. Does it matter? I manage my clients' money according to their needs, regardless of where the market is. It's, that this is fun to talk about, but I came out on March 24th and said, we've hit the low for this market. The day before was just, March 23rd on Monday was the low. I said that the next day, we're done. We saw the low. I actually said that. It doesn't change the way I invest for my clients. It doesn't mean I'm putting all of my clients 100% into aggressive stocks. And it didn't mean before that I had all of my clients into cash. We still invest according to your time horizon, your needs, your risk tolerance, your goals. And generally speaking, we have more than one goal. There are a couple of comments out there. So let's just take a look to see who's out there. Okay. So I'm going to start from the beginning. Stacy, we actually chatted before the chat, and we were talking about a reality check, and she said, Stacy goes, I don't want one. And I promise you, like I said, hey, I'm not going to break anything by doing a reality check. In fact, I think short-term technicals are still extraordinarily bullish. It's one thing when the Dow is up like 200, 250 points this morning, but to close the day at the high of the day, almost up 600 points in the Dow. These are extraordinary moves. So we had a record from peak into recession. We had a record drop to go into a recession. It was just rapid and record drop into a bear market. So the stock market had a record plunge in just a few weeks into a sharp bear market. And now we've had a record coming out of it. This is why we talk about a V shape. That's what it means. Record, down and then right out. Okay. Russell, very smart. I read this comment before we did the live. Mitch, here's a text I got from an intelligent person regarding the market. I assume you'll touch on some of these points. Pandemic, 30 million unemployed and counting. Cold War with China, cities across the country engulfed in flames. Trump hiding in a bunker. Market is up. Okay. Your friend is just wrong about one thing. It's more like 40 million people unemployed. But I see the point, and it's a very serious point. I spoke about a lot of our cities being engulfed in flames and the George Floyd murder, because that's what I think it is, and these other issues on Monday. And how could the market be up when the world is on fire? Cold War with China, all of these things going on. The economic forecasts all point to coming out of these issues. Now, if we never come out of these issues, I'm not saying, well, I'm really trying to choose my words carefully here. I'm very sensitive to these things, okay? But the economic modeling calls for an economic recovery later this year and a much improved economy in 2021. The riots will pass. I hope you don't go back to the way we were before, because we've got to fix this situation. It's just we can't keep having another George Floyd. It's like they're too often, and these are only the ones that you see that are recorded on someone's smartphone. Okay, so anyway, short term, the technicals are extraordinarily positive for the market. Filippo gives me a suggestion: T-shirt idea, Mitch. Q equals infinity pump. Yeah, I like it. I like it a lot. Hey, Joanne, how are you? Joanne, thank you for joining me. It's been a while, and I haven't seen you for a while here. Thank you very much. I was starting to miss you. I was like a little worried, but then we're friends on Facebook, and I see you're just living the life. And I'm very happy for you. Good for you. Hi, Mitch. So glad to see the market up. Yes, aren't we all? And we're going to talk about should the market stay up and what we should do in a moment. Okay. So thank you for joining me, Joanne. Howie's out there. How much of the stock market rise is Fed induced? A lot. Can I quantify it? I mean, some people will say it's all on the Fed. I don't buy that. I think there are a number of levers that are being pulled. It's not just the Fed. If you think about what what Congress has done in terms of fiscal stimulus, everybody who's eligible got a $1,200 check. Another thing that's holding things up is that there's a moratorium on evicting renters, and there's a moratorium on foreclosures. So people are worried that when these moratoriums end over the next couple of weeks, that we're going to go into like an eviction and foreclosure cliff. We'll see what happens. But based on the mortgage application figures, a lot of people are out there buying homes. So we'll have to see how that goes. Let's see here. Russell, I agree on your point, long-term perspective, and agree on near-term, even though it seems crazy. It does seem crazy. I mean, if you take a look at the ingredients, and I've said this before, and I just want to say it again, if the stock market reflected the current state of the social chaos, the massive civil unrest, and the state of the economy, the recession, the stock market would be, 40, 50% lower than where it is right now? But investors who buy stocks are looking ahead. They're looking past the valley at the next peak. I spoke recently in depth about how the stock market could do well when everything else is so bad. So think of it this way. The S&P 500 is a market cap influenced index. Okay, well, we'll have to say this. You can't invest directly into an index. You could invest in a security that tracks or mimics an index. But a Macy's compared to Amazon. Macy's is like a $5 billion market cap, and Amazon is a $1 trillion plus market cap. If Macy's went to zero, you wouldn't even notice it in terms of the S&P 500 index. You wouldn't even see the index. I don't think the index would even drop a tenth of a percent, because the smaller size of the company, the less influence it has on the market. The work from home technology environment we're in favors companies like Amazon, Microsoft, Apple, Facebook, Netflix, Alphabet, which is Google. And since those are also the biggest market cap companies, they keep going up, and they're just, and I call them the great black hole of the stock market universe. They pull everything in. They pull everything into it. So when those stocks go up, they pull everything up with it. And when those stocks go down, they pull everything down with it. So you have to, keep that in mind. And that's what we're seeing. The stock market doesn't trade your local bakery or your local office building. It's trading big companies, and that's what's being favored in this environment. Okay. So let's take. Hey, Phil, good to see you, my man. I love your Facebook picture, by the way. Phil, always good to see you. Thank you very much for joining me. And we have Joanne. I know. I'm sorry I've been absent. You are. That is very sweet of you. That is very, very sweet. You have been absent, but that's good. You're here now. And listen, I kind of figure that as the weather gets nicer and people start finding other things to do, and the the social distancing is reduced, people are going to have nice things to do, and it's all good. That's why I don't do these anymore on Fridays. I stopped doing these live streams on Friday. I'll probably go back to Fridays in October, and we'll see. We'll see how it goes. Okay, so what should you do now that the stock market is up? I think that's really the actionable thing that I want to leave you with. If you felt that you were overly invested in stocks, or your portfolio was just too, right back at you, Joanne. Okay. If you felt that you were too invested in stocks, and you were too worried that the damage to your investments was so bad about 2 or 3 months ago that it was going to hurt your financial future, or you couldn't sleep, or whatever your reason is, now is a good time to rebalance and maybe say, my stocks have come back. I need to rebalance and put some stocks back into more stable investments, such as fixed income or cash. Okay, maybe it's time for you to do that. Or if you have new assets to commit to the market, you have to be really careful and really selective. Look, you always have to be careful and really selective. Sometimes you see these soothsayers and strategists on TV say, well, this market's going to be a really careful, stock picking strategy kind of market. It's always like that. It's never not like that. You should always be careful. You should always think of the downside, and you should always think of, can you handle your investments going down? By the way, just because an investment goes down doesn't mean it's a loss. You could pick a great investment over the next 20 years, but it's going to do a lot of up and down trading, between now and then. So that's really, it's really about it. I think we have got more upside over the short term. The technicals remain strong. We've got the Fed putting probably more liquidity into the economy than we really need. My heart goes out to the George Floyd family and all of the people so negatively affected, and things have to change. I want to say that because I don't want to, I'm very sensitive to these things. I made a whole live presentation this past Monday about this stuff. Check it out. It's on my YouTube channel also, by the way. I'm very sensitive to that. But, when the point I'm making is that the riots, the fire and the windows, all these things you see going on, that delays state reopenings in a lot of places, and in particular cities, and that's usually the biggest concentration of wealth are in the cities all over the country. So it delays things, and hopefully it doesn't exacerbate a rebound or spark a rebound in COVID cases. So there's always something to worry about. There's always a reason to say we're not out of the woods yet, but you have to pick a direction. And if you're going to be invested, this is the information you need. Okay, so if anybody else has a comment or a question in the comments, hit me up in the replay. I'm going to end this broadcast now, and I want to thank all of you for joining me today. Thank you.